Now, bond yields initially spiked on that stronger ISM services data this morning, but the 10-year then reversed back below 4.3%. It's supporting markets to some extent, the Nasdaq in particular. Today, it's outperforming with a 1% gain. And my next guest sees plenty of opportunity there still in tech and in the industrials that power it. Let's bring in Margaret Patel, Senior Portfolio Manager for Multi-Asset Solutions at Allspring Global Investments. Margie, it's good to see you again. And I like the simple way you framed that as industrials now exist to power tech. And so plenty of people, I think, would be happy with that second order trade.
Yes. Well, we think that there's still a lot of strength in the economy, again, selectively in certain sectors, in technology, in industrials, that particularly are tied to the secular strengths, such as data centers, improving the electrical grid, automation, making the grid more safe. I think those are the areas of even industrial we're seeing a lot of strength. So we think the economy is going to do, at least the market will do, surprisingly well as it has so far this year.
You know, there's I'm thinking about the discussion we just had in Steve's case and Luke's case for why the Fed should cut rates here. And the line from Michael Hartnett over at B of A always sticks in my head when he says, history suggests you should sell the first cut. Do you think that will turn out to be the case this time again, that investors should sell the first rate cut, that the market could drop anywhere from 20 to 25% in the subsequent months?
I think that's very hard to see. I think one thing we've learned over the last couple of years is you can't look at the history books to tell you what to do, how the market will react in previous cycles. I think that's another example. And really, the market here has raced ahead of the Fed making a decision when you have the 10-year down at a 4.3. That tells you the market is expecting a rate cut, thinks it's appropriate, and the Fed really should act because they say they look at the market for signals, and they're getting about as strong a signal as they should get. It would be time for them to cut rates.
So you're also clearly in the cut rates camp. I mean, what 3 weeks ago, everyone was talking about how maybe we might need to do another hike. It's incredible how quickly things change. You get a soft PCE report, you get a market that sells off, lose, and now we're all back to the rate cut camp, I guess, except that expectations are certainly not there for July. Do you think they should do it next month?
Yes, I think they should, because I think, in a sense, it's not really going to matter as far as economic growth over the, say, short or medium term. They really only have a small window before it's time for the election, where they traditionally have been very quiet. So they really need to act in the next couple of months to be in a holding pattern for the last few months of the year. So I think they should. The market's saying they should. And we think that it won't cause inflation, and we don't think that it will really cause any disruptions in the economy. It looks like it's the right thing for them to do.
You wouldn't
give the market what
I'm sorry, I didn't mean to clip you there. I just was going to say you wouldn't go so far as to buy bonds, I assume. Now, we've never talked about bonds together, but we always talk about stocks. But I don't know if you would kind of go that far in your line of thinking as to say, the highs and yields are in.
Well, I personally think, say, the 10-year is more or less in a trading range of, say, 4 to 4.5. Whether the Fed keeps rates where they are or where they cut rates, I think that's probably just about the right rate. We have a huge amount of Fed supply. Inflation is a little above 2%. That looks about right. So I think there's a little bit of money to be made in the high yield side, where yields are higher, maybe, say, 6 to 7%. But I would say, basically, I think in the bond market, in the medium quality, you're looking at a moderate return. I think equities are going to continue to outperform and be up around that 10% growth for the year, as we saw in the first quarter.
You're not worried about a broader economic slowdown?
Well, it's pretty hard to see when the Fed is actively considering cutting rates and very sensitive to the economy, and when interest rates have come down on their own because the market has said we think rates should be lower. And if you look at the economy, all the sectors look in pretty good shape. Yes, there's signs of a little bit of slowdown in labor and industries here and there, but bottom line, it looks as if we should at least chug along at 1.5%. More or less like the first quarter, 1.3, maybe 1.5 to 2%. And I think that's sufficient to keep the economy going, give us some momentum, and also to mean that stocks, S&P, NASDAQ, should continue to be in double-digit rates of return over the next year.
It's fascinating that maybe we can muddle through, kind of what Steve and others have suggested. If the Fed acts more quickly, perhaps we can keep this going. So, I mean, you do have company-specific picks here, Broadcom and Eaton and McKesson. Is that where you think investors should be positioned versus just kind of having broad exposure to the index and taking it, the ups and downs that they may navigate in the months to come?
Well, I think really you continue to need to stay with the leaders in their sectors. That's what we've seen over the last couple of years. Strong, big companies just get stronger and stronger. And although those companies have had great earnings growth, when you look at the smaller capitalization companies, they really have more modest growth, really reflecting that very low economic growth that we've had, say, in the first quarter, 1.3%. So I think that says that the investment themes, I think, are the same that served us well last year and this year. You know, technology, industrials, where they play into those big themes about powering data centers and so forth. And on the healthcare side, we're a little more selective because we think that although the sector is growing, we still think you have to be picky about where you want to be. Companies that can still drive earnings.
Right, indeed. McKesson being that example. Margie, great to check in with you today. Really appreciate it.